Hey, what's going on, traders? Welcome to this video. Hope you guys are doing great today. This is Chris from Rotational Trading, and we're going to do a little video now. So if you enjoyed this content, it's going to be about day trading and some tendencies and areas where traders tend to mess up. I want to kind of explain to you my experiences with some of these things. So you might learn something if you're new to day trading. If you're not new to day trading, it still might be an interesting topic, and I would love to hear your thoughts on it in the comments below. So let's get to it right here, guys. Smash like on the video, subscribe to the YouTube channel if you enjoy this content. Let's get to it right here. All right, cheers. Okay, so what I really wanted to focus on in this video particularly is the different types of sessions that we tend to get and how the current day's session will be or could be affected by the previous day or previous 2 days sessions. So the way I see it is there are multiple types of markets and behavior that will happen in a market, meaning there's different types of days. Okay, so you can be trading the same market every single day, and the more you trade it, the more you're going to realize that every session almost has its own feel. It almost feels like you're trading a different market every single day because there are so many different ways that a market can trade. A lot of the aspects I discuss in other videos affect how your market will be trading on a given day. Some of them being liquidity, volatility, the velocity, the market's correlations, basically how this market is moving on that given day and what other aspects are there at play here that are contributing to what this market is doing right now. Okay, so the first type of day that I would categorize is a rotational type of day, meaning a market that is moving around in a range a lot. So you might have, a market that's here, then it moves up, comes back in, tests lower, comes back in, tests higher, comes back in, tests lower again. It's kind of rotating its way orderly, and maybe value might be slowly shifting lower or slowly shifting higher in the case of certain types of trend days. This type of session in particular is a very important session to understand, and you need to understand what can cause this type of session first of all. So again, I'm just scratching the surface here. Another type of day we can get is a more of a momentum driven day where the volatility condition is a lot higher than on a typical rotation type of day. So this would be an example of a day where NASDAQ, again guys, I'm more of a NASDAQ trader, where NASDAQ would be moving minimum 9-10 points around at a time. And that is considered pretty good volatility, pretty high volatility. If it's moving more than 10 handles on not a lot of volume, and there's less than about 3 contracts at every bid and offer, that's what you would consider a very low liquidity, thin day, and the market will be overshooting levels by over 5 points at times, and basically it has a lot more randomness to it. You would call it more of a momentum driven day, and this is the type of session where you definitely want to be managing your trades faster if you're scalping, and you do not want to be staying in trades too long because there's a high probability you're going to get run over by a train if you stay in the trade too long. The next type of session, I would call it a one-sided day. So it would be like this Thursday here, May 20th, where basically as soon as the market opened, NASDAQ was leading the way higher almost all day. And if you know how to read the real time to some degree, you would have seen how aggressive these buyers were, and you would know not to even consider fading it. That's a mistake newer traders make, is that when they see a market skyrocketing up like this, they will try and sell it and average down a short position. And it's a form of ego trading. It's trying to call a top or trying to call a bottom. So besides all of that, you would call this a trend day where the market is very one directional and it is very hard to get filled if you're trying to bid. And oftentimes you'll get a sweep down to take out some stops, and then it'll slowly start bidding its way back up, and it will not give traders a chance to get filled on a pullback. You simply have to buy the high every single time. That's an example of a one-sided day. Again, very hard for scalpers to trade. If you've been practicing trading in two-way markets for a while and then you get a one-sided day, it's normal that you're not going to know exactly where you should be putting your orders on a one-sided day, and it's not an ideal scalping condition either. And the next sort of little nuance here that is important is understanding the correlations of your market. So what we've been seeing, at least for the last few months here, is where the correlations, especially in the morning, can be quite off between the NASDAQ and the Russell 2000. This is a very important thing to be looking at, because this will affect how the market is trading. And again, a lot of this is objective analysis that I've made personally, and I would love to hear your own thoughts on it as well in the comments. It's that depending on the correlation going on between NASDAQ, S&P, and Russell, these markets will become easier or harder to trade. For example, on a day where NASDAQ might be notably weaker than the S&P, You'll notice a lot of these crazy short squeezes in NASDAQ, and that's a very typical behavior that I've been able to identify on certain days where NASDAQ might be leading the way down and S&P and Russell might be holding up a little better. It's little things like that that you can identify that play into how your session will be trading. You know, the market is moving lower overall, and then all of a sudden it starts to hold the bid really strongly, and then it starts bidding its way back higher, and then it'll shoot all the way back up to an area of value, maybe a liquidity pool slightly higher. It's kind of hard to give you an example here, but imagine on a footprint chart you have two sort of value areas. What I'll often see is that the market will be in the lower value area, it'll be bidding up higher, it will shoot up into the higher value area and squeeze out traders that were trying to short it on the lows. Just a light example of how correlations can affect the trading of your market. And the thing about the correlations is that sometimes they're not clear at all. And when they're not clear, they're not reliable. A lot of times off the open, we see Russell up down at the low of the day, NASDAQ up at the high of the day, and then S&P is doing whatever it wants. And in that case, the correlations are not really telling you much. It's simply telling you that someone spreading the market, maybe they're selling the Russells, buying the Qs. What's important to look at is how the correlation continues to develop throughout the session, because often you will see a certain movement on the open and that movement is often very deceiving. Continue to pay attention to how that correlation is developing throughout the session. So do not give precedence to what happens right off the open for correlations. Okay, let's move on and talk about different session types and how previous day sessions could affect the current day session. All right, guys, so if you're on board with this stuff, don't forget to smash like on the video. I know we're getting into some pretty in-depth topics here, but these are things that day traders need to understand if they want to give themselves any chance of making money here. So let's get to it here. So we're gonna start from this day right here, which would have been May 14th, 2021. It was a Friday. Now, look at this type of day right here. Okay, so you can see the profile. Overnight, we moved up higher and then the market shot up and we trended higher for the majority of the day. In fact, the entire session. This is a trend day where the market is one-sided. Okay, if you place a bid, there is a high chance it will not get filled at all unless you are a little bit aggressive with it. We're going to look at how this market traded the following week. Take a look at these 30-minute bars here on the open of Monday morning, May 17th, and you can see that they have large ranges, and overall what we're seeing is that we're trading in Friday's range, and this is looking like more of a rotational type of day. And how you can also identify a rotational type of day is that look at your depth of market on the day and look at how it is behaving, and you can identify that the market is range bound and how it's respecting the upper and lower limits of these ranges. Once we see movements outside of those ranges, normally you get a type of momentum move or value is shifting somewhere else. But overall, the market is moving in a more orderly fashion, more of a rotational type of condition. Now, seeing a rotational type of day is very common after seeing a trend day, and it's easy to understand that. It's because when people trade on a trend day, the bulls are making money. So now they come in on the next day and they're expecting to see something similar because they probably missed this trade the previous day. This next day here, you're going to have traders trying to buy every dip, but they're forgetting to realize that the condition of this day is completely different to what we saw the previous day. I like to give the analogy of a weather forecast. For example, it's been hot and sunny for 3 days in a row, and you go outside on the 4th day and you're expecting it to be hot and sunny again. You didn't look at the weather forecast though. You go outside with your short sleeves and your bathing suit, and all of a sudden it starts pouring rain and it's cold. You made the decision to go to the beach simply because you missed out the last 3 days, and now you want to make up for what you missed out on, but you didn't look at the weather forecast. You just went straight for it. That's an example of how traders will get caught trying to trade breakouts on a day that is clearly rotational. Okay? And I'm making it sound like it's something very simple, but in reality, it's not that simple, okay? If you're able to identify a rotational type of condition, there is still no guarantee that you're going to be able to execute a trade in that condition. It will definitely take a lot of practice and understanding to first see the condition that the market is trading in, and then force yourself to adapt your strategy to that condition and not trade any other type of condition, okay? Here's another example of what I just described. Thursday, huge trend day. Friday, more or less rotational in the morning, and overall downtrend exploring the range of Friday. Okay, I do believe that understanding your current day's action from the perspective of what happened the previous day or previous 2 days will help you to identify what your current day's session will look like, more or less. So I knew going into Friday morning that we were likely to see more of a rotational type of day. For example, Thursday, you would have made money buying any top. Now try and do that on Friday, you're gonna be wrong almost every single time you do it. Because in a rotational condition, I'll try and explain to you what generally happens in a rotational market condition. You need to imagine a range. Let's say, for example, the market is rotating about 8 handles at a time. So I'll give you a range here, 61 to 69. Now, if you place your order anywhere in between that, you're giving up a large edge. Also, if you sell at the low of the range or buy at the top of the range, there is a high probability that you're going to get top ticked in a rotational condition. And obviously there's a number of factors that play into the probability of those things happening. And again, that's why you need to learn how to read the real time so that you can clearly see how the market is trading on a given day. Again, a rotational condition here, 61 down to 53, up to 61, up to 69, more or less, 8-point ranges. On a one-sided day, buying 69s, you have a good chance of making money. On a day where you're clearly seeing a lot of two-sided rotations, you really don't want to be long at 69s in that case. The market has established these ranges in front of your face, and you can clearly see that the market was bidded at 61, offered at 69, and everything in between is sort of a gray zone vacuum area where there's not really a lot of clarity. So the market might overshoot the 69 by 1, 2, 3 points to attract more buyers in, but then it will slowly start fading back. 69 is offered, and then boom, now we stop running it back to 61. Now it's at 61 and you're bearish. You want to sell it. That's the lower end of the range. What will often happen is you sell it at 61, you'll get maybe 1, 2 points of follow through, then it will slowly start bidding up against you again and then run straight for your stop. Now that's an example of a trader trying to trade a breakout on a day where it's doing two-sided market activity. It's very funny because a lot of newer traders will call that choppy activity, when in reality, it's called a trading range. And I would argue days where the market is more rotational in a trading range offer way more opportunity from a scalper's perspective than days that are one-sided where you can't even get filled on a reasonable bid. And what I just described to you about how a trader will be trying to trade a breakout on a rotational condition, this is the type of trading that will result in a trader blowing their account up because they're forcing a certain idea onto a market that is doing something completely different. The trader is not able to see what is really going on. And what they do is they continue trying to fight against it, right? So they sold 61s once, they lost. Then the second time it goes to 61, they're going to sell it a second time. They might get 1, 2 points follow through again, and then it'll run straight back through them at 68. And then he might even try it a third time. The third time, he might get 5 points of profit. And then that time it's going to come back again, test out his break even. Because this trader is on tilt, if it's a newer trader, at that point, after taking 3 trades at the same price, if he's not able to admit to himself, listen, what you're doing is not working for today's market, that's a trader that has a high chance of blowing up his account on that day if he continues trying to force his opinion onto this market. I just wanted to talk briefly about execution. A lot of days you might see the condition very clearly, but being able to execute the trade is still very hard. For example, yesterday's market, May 21st, I saw it so clear in front of my face, the pivots that were going on the depth of market, yet I was not able to trade it. I was getting tricked out by those 2-point overshoots of the price, and I was not patient enough to stay in the trade. What would happen is often I would get in the trade, I would take a scratch or a very small loss. As soon as I would be out of the trade would start to follow through. And when this happens to you, it's very important to use that information for good, not for evil. Not to get angry at the market when you get out of a trade for break even and then it follows through in your favor. What it's telling you is that you're reading it right, your execution and your trade management is slightly off. So when you have these types of trades where you notice that you're executing at the right price, but your management is slightly off, what you really need to do is go back and review the trading on that session. Look at how the market was behaving around those pivots, how it would often overshoot the level by 2-3 points, come back, slowly start offering or bidding it back, and then the trade starts to follow through after that. That type of behavior needs to be reviewed for future sessions. Remember guys, you don't need to be the best trader in the world, you simply need to be better than average. And you going back and reviewing those little details, those little nuances is going to separate you from the average trader here. All right guys, we're gonna leave it there for today. If you enjoyed the content, I'm happy about that. And I will catch you soon. Take care, bye.